Hello.
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 One more difficult no money be study on no more. One money mo mbane share no. No more tia double fee or say ho. As I said, no more transfer na fa say ho na. Imagine in 10 time na ko ini. Okay, so welcome to the stream today, and we are also streaming live on YouTube. So it's an open air discussion today. We want to bring up our stream as well on YouTube, but we're going to be looking at some questions relating to two things generally. Ratio analysis, it's a done deal waiting for us in the exam hall, CRFR. And also we will share our thoughts on another question relating to, how do we call it? Ethics, okay? Ethics. So we're going to be going into these today. For those of you joining us on YouTube, give us a thumbs up and then share the video as well for us as we go ahead. Those of you joining us on YouTube, what's that? Okay. So we have done ratios. I mean, last week, Sunday, we spent some time to look at ratios and solving some questions relating to it generally. Taxi via Yango and get an extra 10 Ghana cedis of your first. Sorry. We saw the various questions relating to the question we solved in class. And I dealt with the various challenges that you may be facing as you look at the ratio questions. So we want to look at yet another question that has just a slight perspective that we want to look out for. And there are various other types of ratios that we will be looking out for. But as we are starting with our executive revision masterclass, we want to go through these questions to see exactly what we can do in that regard. So we are going to start with Yogi. I think for those of you in the FR class, that was an assignment we gave to you. So we were going to go through Yogi, solve it up, and then we will solve one question as well on ethics. So we see what we can do. So let me bring up my screen and let's go quickly. So Yogi is in your question kit, and that should be on page something. Gosh, give me a moment. All right, there we go. So Yogi is in the question kit on page 134. It's available in your question kit. You can go there and pick it up. Really straight from there. It's a very simple question, but has just some few adjustments that we would have to make. And so let's see what we can do in relation to it for this one. Let's go to the requirement directly. It says calculate the equivalence ratios for Yogi I for the year ended 31st March 2014 after excluding the contribution made by the division that has been sold. After excluding the contribution made by the division that has been sold. So we are to calculate the ratios for 2014, but then we are supposed to exclude the contribution of a certain division that has been sold. We don't know the contribution, but we're going to read a question and see what the heck the examiner is talking about. I says that for the year ended 31st December 2015, excluding the profit on the sale of the division. So two sets of ratios are supposed to be calculated here. We are supposed to calculate for 2014, taking the contribution, the entire contribution of a division that has been sold. Then we are supposed to calculate also for 2015, excluding just the profit on the disposal of the division that is in question. That is very important to us here. So let's go to the beginning of the question and let's see exactly what we are supposed to do. Yogi is a public company and extras from its most recent financial statements are provided below. So we are given the financial statement for 2015 and the previous year, 2014. Sorry. Note. It says that, note one, on 1st April 2014, now stay with me carefully, the year ended of the company is 31st March. So 1st April is the beginning of the current year. So at the beginning of the current year, which is 2015, Yogi sold the net asset, including goodwill of a separate operation division of its business for 8 million cash, on which it made a profit of 1 million. So we got to start to, gather some thoughts quickly as we look at the discussion. Give me a moment. Yogi. So we begin to gather some thoughts. So stay with me carefully. It says they sold a company or a division for 8 million and made a profit of 1 million. And made a profit of 1 million. So if they made a profit of 1 million and they got a cash of 7 million, that means that the carrying amount of the division that was disposed of was what? So workings, 1, carrying amount of division sold will be, let's see, are we working 3 zeros up? It looks like. Yep. So the carrying amount of the division sold will be the cash received. That is 8 million less the profit from the disposal. And that is 1,000. So that our carrying amount of the division we sold is 7,000. Are you okay with that? If there are any things, you raise your hand, we bring you up, or you put it in the chat for us. So the first thing we need to calculate is, what is the carrying amount of the division that has been sold? Why is that important? Because remember, the structure of the question is that we are supposed to calculate the ratios for 31st March 2014, that is last year, excluding the contribution made by the division that has been sold. So it means it is important for us to identify the division that has been sold and work at it. So since I am there, I'm going to go to workings 2 to try to calculate the capital employed for workings for the 2014. And I want you to stay with me carefully here. So capital employed, 2014. Now, in the context of this question, it depends, but you know there are 2 formulas generally for capital employed. We could use total assets less, current liabilities in that particular case. So we're going to go with that approach unless otherwise. So total assets for 2014. So you go to the question, 2014 data is on the right side, the far right. So total asset for 2014 is how much? 29,200. So we bring that up. Then remember, we've sold a division at the beginning of the current year. So if we are dealing with 2014, for comparison purposes, we have to remove it from, sorry, I don't know. We have to remove it from the capital employed for 2014. So we're going to less carrying amount of division disposed. Or division sold. And that's coming in from workings 1. So we less it. Okay, we're going to less that. Then we will less current liability as well. So for 2014, what is our current liabilities? Check it up here. Current liabilities has been given to us as 7,200 for 2014. So we bring it up. That will be less as well. So we have to continue to read. I'm not going to close this one up. We have to continue to read because probably this is not how we are supposed to calculate the capital employed, because something could come up. And if it does, then we will modify it the way we are working ourselves up generally for the context of this question. But we bring in total assets, then we will less the carrying amount of the division that has been sold. Again, why are we lessing the carrying amount of the division that has been sold? It's very simple, because we have to remove the impact of the division that has been sold. It was sold at the beginning of 2015, but we have to take it from 2014 to enhance comparability of the financial statements, because we want consistency in the financial statement. Hence, we have to remove that. So I've just read the first sentence of the scenario, and I mean, we've done a couple of workings, but let's continue. This transaction required shareholders' approval. And in order to secure this, the management of Yogi offered shareholders a dividend of 0.4 cents for each share in issue out of the proceeds of the sale. We don't know what the heck is going on here, because it's more or less like management gave shareholders bribe to sell their assets, literally, because they sold their assets and they paid shareholders 40 cents per share. So if you do the math, the shares are 10,000 because it's a $1 equity shares. So if you do the math and you want to see the dividend they paid them, the dividend they paid them could look like 0.40 times 10,000. And so that would be about $4,000. So the 8,000 or 8 million proceeds they had from the issue, half of that was given to the shareholders as dividend so that they will approve the disposal of the division. Now, this will be a worry for us when we go to the interpretation. All right. It doesn't have any impact on the calculation, but when we go to the interpretation, then we can justify exactly what is going on. Because why should shareholders be convinced, be given half of the proceeds from the disposal of a division so they can approve it? We don't know, but we will find out shortly. The trading results of the division which are included in the statement of profit or loss for the year ended 31st March 2014 are as follows. So this is the results for the division that has been disposed of. For the 2014, this is the division that has been disposed of. This is their results for the period under review. So we have two options. Option number one, we could decide not to do any adjustment and do the adjustment whilst we are doing the calculation. Another option for us is to readjust the P&L of the entity for the 2014 results so that we can get absolute results that we have to deal with. Now, I like to keep my things a little bit cleaner. So let's go to workings 3, and we're going to deal with the adjusted statement of profit or loss, or what we call revised statement of profit or loss for 2014. And this is excluding the results of the division sold. Okay, excluding the results of the division sold. We're slashing our currency sign. So we're going to have revenue coming in. So let's go pick up revenue for 2014. Go to the P&L accounts. Revenue for 2014 is an amount of 50,000. So we're going to pick that 50,000, and then we will less the division revenue of 18,000. So 50 minus 18, and that is going to give us what? 32,000. Then we less cost of sales. The total cost of sales for the period has been given to us to be, go up and pick it, 30,000. You add the division that has been sold, 10,000. Sorry, you subtract it. So 30,000 minus 10,000, that's going to be 20,000. So that our gross profit for the period under review is going to be an amount of 12,000. So that's the gross profit. But let's continue. We're not done. Back to the P&L. It says profit from the sale of the division. Don't worry, we're going to come back to this. And moreover, that is not in 2014. There is nothing there, so no P. So we bring in distribution cost, and that is 5,300. The division that has been sold, their distribution cost is 1,000. So distribution cost 5,300 minus 1,000. That's 2,300. Then we bring in the next item, and that is going to be an amount of administration 2,900. Sorry, this is going to be 4,000 rather. 4,300. Then we bring in administration cost. Our admin cost here is 2,900. The division that has been sold is 1,002. 2,900, 1,200. So we take it out and then bring in our figure for the period under review. And that's 1,700. 1,700. Then what else we got? Probably that is all. We are not interested in finance cost. You know that already. We'll come back to that. So this will give us the profit before interest and tax, which is what we are going to be using for our workings. So our profit before interest and tax is going to give us an amount of 6,000, possibly. So that is the adjusted, or if you want, the revised statement of profit or loss for the period under review in relation to this particular scenario. In relation to this particular scenario. It means this is the results from the P&L that we will use to calculate whatever ratio that needs to be calculated. Then we move ahead to continue to read the story. So you see that again, I am working as I read the question. I've not still finished reading the question, but I'm working as I read. And I always tell you that that is the best thing to do in the exam hall. Yeah, Nhyira, what if there is a question at the bottom? Then, Masa, just go that way. Note 2. The following selected ratios for Yogi have been calculated for the year ended 31st March 2014 as reported above. Okay, so based on the original financial statements, which is inclusive of the division that has been sold, they calculated these ratios. So what we are going to calculate now will be based on these ratios as well for the period under review. So let's go there. Since we are done, it means that we can close up and get our capital employed for the 2014 under review. And that gives us an amount of 15,000. That gives us an amount of 15,000. And that is going to be the capital employed we're going to use to do our calculation for the 2014. Any questions you put in the chat or you raise your hand and we bring you up. So once we've done these workings, the next thing we have to do then is to go and answer the questions. So the I aspect of the question said, we should calculate the equivalent ratios, excluding the contribution made by, the division that has been sold. So let me just pick this up. So let's see what we have. First, what are we supposed to calculate? Gross profit margin. So we bring it up. And that is going to be your gross profit divided by sales times 100. Gross profit divided by sales times 100. So we bring in the gross profit adjusted, which is the 12,000 here, okay? Divided by the sales adjusted 32,000 times 100. So we punch that out to see the figure we get for that.
37.5.
So 37.5%. Next ratio, operating profit margin. Remember, another name for the operating profit margin is net profit margin, and that's going to be profit before interest and tax divided by the sales. Make sure you write that in full. I'm just being lazy here. So my profit before interest and tax is 6,000 adjusted, and our sales is still 32,000 times 100. Let's see how much we get for that. $18.75%. Now we need to see the way they've left their answers. They left the answer in one decimal place. So maybe we can do 18.8%. Now that doesn't mean if you leave your answer in the 18.75, like you are wrong or something like that. We just want to, go ahead with that. But you can leave the answer in 18.75. The next one, returned on capital employed. Now stay with me carefully because the examiner has given you the clue on how the heck it's supposed to be calculated, right? So the examiner is saying that it should be profit before interest and tax divided by what? Total assets minus current liability. So we've been told the how of the calculation. So let's go. Rosie, for Rosalinda, it's going to be profit before interest and tax divided by capital employed. Divided by capital employed times 100. So profit before interest and tax, what do we have? 6,000 here from our adjustment. Divide that by the capital employed, 32,000 times 100. So let's punch that out to get our Rosie. Sorry. That's not the capital employed. That's the sales figure. Capital employed is here, 15,000. Because I realized that I'm going to get the same answer and I'm like, geez, I'm beginning to make a mistake. That gives us an amount of 40%.
40%.
40%. So our Rosie is 40%. Then we move. The next one is net asset turnover. Net asset turnover. So we bring it up. And you know that is going to be your sales divided by capital employed. Make sure nothing whispers in your brain to go and do times 100. Make sure nothing whispers in your brain to go and do times 100. It's not the devil, but because the devil doesn't know your address. You're not big for the devil like that. So make sure nothing whispers in your head. So no times 100 because turnover will be reported in times. As indicated in the question, it's reported in times. So our sales figure is going to be 32,000 divided by the capital employed. We already have that, 15,000. So let's see how much we got on that. Maybe 2.1 times. How did they leave their answer? They left the answer in 2 decimal places. So we can do 2.13 times. So that is the I aspect of the question, calculating the ratios for 2014, excluding the contribution made by the division that has been sold. Excluding the contribution made by the division that has been sold. So it means getting our carrying amounts for the disposed division, calculating the capital employed well is also very crucial here. So you realize that in the context of this question, even though the examiner said the capital employed should be total asset minus current liability, there is another thing that we are learning, which is the carrying amount of the division that has been disposed of. And that is something significant that you have to really know about and pay attention to. Then we look at the II aspect of the question, and it says we should calculate the same ratios as we have done, but this time around for the 2015, and just exclude the contribution made by the division that has been sold. Sorry. It says for the year, excluding the profit from the sale of the division. So just want to pick this up. So we go to the II aspect of the question to bring that up. So that is II. We're going to calculate the same ratios. So in my second scenario, I'm not going to write formulas down because the examiner knows that I know the formulas. So I just go straight and do the calculations. Okay. So in the second one, you don't have to write the formula down again because you've already done it. You don't have time in the exam hall to be wasting like that. So we go to the second part of the question. And this time around, we are going to be focusing on the 2015 results. So 2015 gross profit is 12,000. So that's 12,000 divided by the revenue, and that's 36,000 multiplied by 100. And we get our answer for the 2015. Getting something like 33, maybe 0.3%. What's the next one? Operating profit margin.
It's 37.5.
What is 37.5?
Gross profit.
How is it 37.5?
No, it's 33.
12,000 divided by 36,000. Okay. Sorry, I used 32.
Okay. So operating profit margin, we're going to pick the operating profit. Now be careful here. The examiner said we should exclude, remember the requirement. It says excluding the profit on the sale of the division. So operating profit, we are supposed to use the profit before interest and tax. Now, how do you get a profit before interest and tax here? What you have is profit before tax. So pick the profit before tax figure, add back the interest of 400, then we will less the profit from the disposal, 1,000. Sounds good? So let me do that somewhere so people don't scream at me. Workings for profit before interest and tax. I'm not supposed to, you're not supposed to do those workings, but for 2015. I just got to do it so you know what we're doing here again. So we pick the profit before tax figure. How much is that figure? Let's go pick it up. 4,300. But the interest has been deducted in arriving at this figure. So that's why we have to add it back. So add the finance cost back. And in the context of this question, it's 400. So we bring it up. Then we are supposed to exclude the profit from the sale of the division, which is 1,000. So we will less it. Less profit from disposal, which is 1,000. That gives us the revised profit before interest and tax that we will use in 2015. Sounds good? Paying attention to the context of the question. We are bringing this because the examiner says it should not be part of the workings. If not, we would have just added the finance cost and au revoir, messieurs. Go ahead. And go ahead. So let's see how much we got. That's 3,700 for a revised profit before interest and tax. So we're going to use that 3,700 here. So 3,700. And that is coming in from workings 4 divided by our sales, still 36,000 times 100. So let's get a figure coming up.
Insha, please, the addition, is it not 7,300?
Which addition?
The workings 4.
Mibao. No. It's 400 though. The finance cost is 400, not 4,000.
Oh, okay.
So 3,700 divided by 36,000 times 100. And I'm getting 10 points, maybe 3%.
10.3.
Okay. So again, pay attention to the context of the question. To the context of the question. The fourth thing is what? Rosalinda. So let's bring in Rosie. So Rosie is going to be profit before interest and tax. We have it already, 3,700 divided by capital employed. I'm not going to calculate that. You know that, right? You know how we will pick the figure. So total asset is 22,500. Current liability is 5,500. So 22,500 divided by 5,500 minus 5,500.
17,000.
Okay. So you just do the arithmetic directly.
21.8.
21.8. Okay. So that is our Rosie there as well. All right. So 22,500, 5,500. Then we can put the 3,700 a little bit in the center. 3,700. Again, that's coming in from workings 4. You know that already. Then the last thing is asset turnover. Net assets. Turnover. And that's going to be rev, which is 36,000. Divided by capital employed. I think someone said 17,000 somewhere.
17,000. Yes.
See, you see that something was whispering to me? I was going to do times 100. I've been doing times 100, so I'm at
0.1.
how much?
2.1
2.1.
times.
Okay, 2.1 times. So that is the idea. Let me do something. So, Nhyira, how did you get the 17,000? The 17,000 is derived from this. So let's just draw an arrow so people know we are picking the same figures. So these are the ratios to be computed in the context of this question we have. So now let's put the pieces together. And I'm not technically going to be writing ratios, the analysis for you, because in the previous example, I wrote it. So this one, I'm not going to write. I'm just going to talk over it. So you listen attentively and write your own thing. I'm not going to write anything for you as you are lazy like that. You want me to write everything for you. So I'm going to put a summary sheet up. And it's going to look like this. So 31st March 2014. Gonna have the revised ratios here. 31st March 2015. That will be as reported. Then we will have the 2014 original also as given. So something like this. Now, we don't necessarily have to bring the, previous results as given, because we are going to be comparing technically the revised and this. So let me just ignore this one and just stay with this two, because these are the two we're going to be comparing technically. Okay. So we calculated the gross profit margin. What were we having? 37.5, 33.3. Then next one, operating profit margin. What do we have? 18.8 as against 10.3. Then Rosie, 40 as against 21.8. Then net asset turnover, 2.13, 2.1. Now, if you look at the context of this question, someone will say, the asset turnover is almost the same. Now, if you do that, your analysis will be substandard. So what you want to look out for to be able to really talk about revenue will be to look at the absolute figures. So stay with me carefully. For the 2015, we realized that revenue is 36,000. From our revised 2014 financial statement, revenue was what? 32,000. So you realize that in absolute terms, revenue is increasing by what? 4 million. Agree? So increase in revenue in absolute terms is 36 minus 32. And that gives us the 4,000. Are you following me well? We are beginning to do the analysis. I'm saying that if you use the asset turnover in the way, the raw format of the asset turnover, the way it is, your analysis will not be reasonable, because what will you say? You will say that, oh, the asset turnover is the same. It means that the entity generated the same amount of revenue. No, you will be lying. Because in absolute terms, the revenue has gone up by what? 4,000 or $4 million. So this is what you have to do. Remember in the earlier question we solved, the previous question we solved, the same scenario was there. So we didn't use the asset turnover. Rather, we used the growth in the what? Revenue. That's the same thing that is happening here. So anytime asset turnover presents us with answers that, you know, we cannot really reach significant conclusion, you are better off to use the absolute movement in the revenue in this case. So what's happening here? Let's see. In absolute terms, revenue is going up by 4,000, but look at the ratios. All the ratios are deteriorating, are reducing, are falling like mango. So all the ratios are falling. So gross profit margin falling, operating profit falling, ROSI falling, net asset turnover falling. But you need to find out what the heck is going on. You need to find out what the heck is going on. Now, you will see that, stay with me carefully, stay with me carefully. If you look at it in absolute terms, distribution cost is 3,500. 3,500. Administrative expenses is 4,800. When we look at the revised results, the revised financial statement we prepared here, our distribution cost was 4,300. So what is telling you? The distribution cost is reducing, but the operating expenses, administration expenses is what? Rising. Are you getting it? Now, again, we are doing the analysis, so I have to, draw some conclusion in relation to what the heck is going on. So we could say that, yes, operating expenses is rising, increases, but you have to be specific on the individual items, because if you say, oh, operating expenses has increased, you are lying, because distribution reduced whilst administration expenses rised. So what the heck is going up? So in my analysis, I'm going to do the breakdown of the two like that to see what is going on. Now, so admin expense is increasing. Why is that? Increased, but then selling and distribution or distribution cost reduced. So in your analysis, you have to draw the line. You don't just say, oh, operating expenses is going up. No. You have to draw the line. So I have seen the absolute rise in the revenue, number one. Operating expenses, I have analyzed what the heck is going on. Remember, the reason I'm doing this is to help me in my analysis write up. Okay? In my analysis write up, because if operating profit margin is reducing, ROSI is reducing, the reason for these two ratios reducing is partly increase in administrative expenses, which is true, because when administrative expense goes up, these two ratios will fall. But then let me also look at the cost of sales situation. 2015 cost of sales is 24,000. Let's look at a revised scenario. The cost of sales was 20,000. So it is 24 here, but it's 20,000. So it tells us that year on year, cost of sales has also increased for the period under review. Because remember, if I'm interpreting gross profit margin, I have to talk about the revenue and talk about cost of sales. These were the principles we established. So cost of sales increased, by bring in the absolute figures, 24 and 20,000. Now, not necessarily bringing in the absolute figures all the time, okay? And the revised was 20,000. So we are increasing in absolute terms by 4,000 on that. But like I said, it's not always that we are going to be referring to the fact that we are increasing in the absolute terms for the period under review. So this is what is going on. But again, remember, there was a statement in the note 1 that they had to pay the shareholders to approve the disposal. So the question you want to ask yourself is, okay, the division that they disposed of, what is the position of the division that they disposed of? So maybe we can calculate the gross profit margin for the division that was disposed of. Again, like I said, I am going beyond the ordinary here because I want to do the la creme analysis. So I'm going beyond the ordinary. So just follow me in relation to the way I'm trying to gather the thoughts together. Then we're going to think about it together. So certainly I have seen the change in revenue. I've seen the change in operating expenses. I've seen the change in cost of sales going up. Then I want to look at the gross profit margin of the division that was sold. Because if the gross profit margin of the division that was sold is significant, then we got to investigate what the heck went on. So gross profit margin of the disposed, division. Let's try to see what the heck we have. That'll be 8/18 because the gross profit is 8,000. So 8,000 over 18,000 times 100. Let's see what we got there. 8,000 over 18,000.
24.4.
24.
44.4.
44.4. Whoa. That's crazy. So stay with me carefully. The division that we disposed of has a gross profit margin of 44.4. But we sold it, and the remaining division that we have now had a gross profit of 33.3. What does that mean? It means the entity has actually disposed of a profitable unit of the entity. So we would have to investigate why they had to pay shareholders for them to approve this fraudulent sales. Literally. So this is telling us that the entity has disposed of the profitable division or segment of the business. Because how can the division have a gross profit margin of 44 and your remaining division that you are going to run with for the rest of your life, whatever it is 33.3%? Why would you do that? That is an issue. So it tells us that we would have to find out why that happened, probably. Now, in the B aspect of the question, the examiner said, comment on the comparative financial performance and position of Yogi for the entity or for the period under review. So this is what is happening. Now, if you look at the statement of, remember the examiner said, comment on the financial position. But in the context of this question, you didn't calculate any financial position ratios. So what the heck are you going to be commenting on? You want to comment on what's going on in the financial statements here, technically. We're going to be commenting on what is going on in the financial statements here. You realize that in 2015, now the entity has some money in the bank. Please stay with me carefully. In 2015, now the entity has some money in the bank. because in 2014, they had no money in the bank. They were rather having bank overdrafts. Let me clean up these circles so you see what the heck I'm writing. In the current year, now they have some money in the bank. But in the previous year, they had no money in the bank. They were having overdraft of 1,004. So what does that mean? It means even though they had sold a profitable division, it has brought in some cash, which has made the entity to have some excess cash above its bank overdraft that it was coming from in the last year, meaning that now the entity will have a better liquidity position in the 2015 than it was in 2014. So yes, it sounds like they have sold off a profitable division, but that brought in some cash in order to deal with the liquidity problem of the entity. So that is the comment on the position. That is the comment on the position. That is the comment on the position. So that is how we're going to approach the context of this question. Increase in revenue, operating expenses, what the heck is going on? Cost of sales, what the heck is going on? We can look at the gross profit margin. Then you look at the issue relating to the position of the entity. So that, yes, they have sold profitable division, but that brought in some cash to help the company to be able to run its operation successfully. And that is the context of the way we're going to be analyzing. Like I said, I am appearing to go a little bit deeper in the context of this question because I want you to understand the way such analysis would be done. And you don't have to write a lot in the context of this question. Things are very sweet, simple, straight to the point. And how do you analyze? You start with your net asset turnover impact, the revenue increase, go to the gross profit margin, talk about the cost of sales, talk about operating expenses, and then Rosie will come later on. So if you take it in that order, the interpretation will flow naturally. The interpretation will flow naturally. Maybe I would have to write some one-liner essay on that in a moment. Yes, James, your hand is up.
Sir, my issue is how we calculated the capital employed. If it's someone also go in 2015, let's say if it's someone also add back the division showed, because we know that in 2014 it was included in calculating the ratio. Should someone also
it was included where? We didn't include the results of the division that has been sold.
That's why I'm saying that the ratio that has been calculated in 2014, the capital employed, it is if the 8,000 was not sold in 2015, then the opening balance in closing balance in 2014 would have been the same opening balance for 2015. So if someone decide also to add back the division sold in 2015, is it a good thing? And two, you remember that they didn't ask at the BPA, they didn't ask up to the information given. You will not have opportunity to calculate for, to comment on financial position. And you have the information. Can you also calculate one or two and then use it to explain?
It is not about what you decide to do in the exam, or it is the requirements of the question. In the 2015 results, the examiner said, calculate the ratios for 2015, excluding the profit on the sale of the division. So if you're excluding the sale of the profit of the division, the 2015 results already excludes the division, and you are calculating 2014 without that division that has been sold. So there is no rationale of adding it back. You don't have to add anything back because there is no need to add it back. You can't calculate capital employed by adding back a division that has been sold when the comparative doesn't include that division results. So you can't add it back. Number 2, the examiner said, comment on the financial position.
It was sold, the division was sold in the 2015 year, which means that in 2014 it was not sold.
So what are you driving at? Because I don't get the context of your statement. The context of the question is, calculate the ratio of 2015, excluding the profit from from the division that has been sold. In 2015, the division is not there. It has been sold. So why would you add it back? There is no point in adding it back. So I don't get your statement of, can somebody come and add? I don't know what would make you think to come and add it back, but there is no rationale for adding it back when you have already sold it. There is no basis for adding it back because the 2014 comparative results you've calculated excludes that. So in 2015, it's not there. So if it is not there, why calculate it in the first place? Or why come and add it back? So that is the idea. That is the idea. The division was sold in 2014, not in 2015. No, Ajwa, get a context of the year ended under review. They sold the division on 1st April 2014. That is the beginning of the current year. Because the year ended is 31st March 2015. It means it started on 1st April 2014. So it was sold at the beginning of the year ended 2015. So it wasn't that it was sold in 2014. No, it was sold in 2015 year ended, at the beginning of the 2015 year ended. So Ajwa, please take note of that. It was sold at the beginning of the current year. It was sold at the beginning of the current year. All right. So like I was saying, your second question on, they say comment on financial position, can you calculate any ratios? It's an approach. You can decide to do that, to calculate the ratios for the 2 years and then go away with that. But an alternative is what I've mentioned, where you comment on the cash flow from the sale of the division. How does that affect the current ratio of the entity or the current asset of the entity or the working capital of the entity? So that is what I said. If you look at the statement of financial position, in 2015, they now have a positive bank account of 1,005. But in 2014, they were having a negative of what? 2,400. So it tells you that even though half of the money was used to pay dividend, half of the proceeds enabled the company to pay off its overdrafts and also was able to have some bank balance remaining for the period. So in a way, it has, increased the working capital available for the entity. They were having bank overdraft in 2014, but now they have a positive bank balance in the 2015. So for the statement of financial position comment, you can do that. Or like you put it, you could decide to calculate the ratios to comment on it, but it would be too much work. So that is why you would have to just look at the position or movement in the cash flow position of the entity, and you'll be better off there. Okay, you'll be better off there. Because if you look at the other indications, inventory is falling. It tells you that the division they have sold, because the inventory of the division they have sold would be here, and trade receivable. The reason why you cannot calculate the liquidity ratios is that this results here. If you come to the current assets, what is the inventory of the division that was sold? We don't know, right? What is the trade receivable of the division that was sold? You don't know. So calculating it and analyzing, you will be wrong. So that is why you just have to comment on the movement in the cash and bank based on the asset that has been sold for the period under review. So James, that's the context there. You cannot calculate the ratio here because 2014 financial position has the division that we have sold. but we don't know the inventory of that division. We don't know the trade receivable of that division. We don't know their current liability. So you cannot calculate the ratios because who calculate here, who compare, and fa. That's the context about that. Any other questions for me? All right. So that is the idea about Yogi. And yes, Abeku.
Yes, sir, please. The dividend which was paid to the shareholders to approve the sales, no?
Yeah.
I saw you did some calculation there.
Yeah.
40 cents times something.
10,000.
So how would it affect the accounts, please?
When it affect the accounts, how?
What would be the impact of such a transaction on the accounts?
Oh, like I mentioned, we had a proceed of 8,000. So in my analysis, I was telling you that they are using half of the proceeds from the disposal to pay dividend, and then the remaining half is what is helping them to pay off their bank overdraft, so that they can have some positive bank balance coming in for the period under review. We are not doing financial statement preparation. If not, that will be part of statement of changes in equity, and it will go to be less from the retained earnings, because dividend payment goes to retained earnings. So we would have subtracted that figure from the retained earnings. Does that make sense?
Yes.
That will be
yes,
the impact on the financial statement.
Okay, thank you.
All right. So that is the idea about this question and what we do there in that regard. So that's it. I won't write in English for you. We have done the analysis already. Go write your own analysis. That is all. So if I want to say something, what I would say is that the profit of the entity, the revenue of the entity has increased by 4,000. So even though revenue has increased by 4,000 in the 2015 year of assessment, the gross profit margin of the entity fell from 37.5% to 33.5%. This is due to the increase in the cost of sales by 4,000 in the 2015 year of assessment. This reduction in gross profit margin affected both the operating profit margin and the ROCE, since these two ratios also decreased drastically in the year ended 31st March 2015. This could be due to increase in operating expenses coming from admin expenses, even though distribution costs reduced during the year. However, the gross profit margin from the section or division that was disposed of is 44%, which is higher than the division that is continuing. This indicates that the entity might have disposed of the profitable division, and further investigation must be done as to why shareholders approved the disposal of a profitable division of the entity. Mary? Then on the financial position part, even though the entity sold a profitable division, it has in a way helped the entity's liquidity position, as in 2014, it was having a bank overdraft of 1,400. However, in 2015, the entity has a positive bank balance of 1,500, indicating that the sale of the profitable division has increased the liquidity position, even though half of that money was used to pay dividend to shareholders to approve the deal. Something like that. That's all. Thinking that I'll be writing something for you to write, then you are lying. I'm seeing some chats coming in. Let's see if I can pick some of them. Emmanuel Dark on YouTube said, "You are welcome." Said, "Okay, good evening, Bonti Nadali." Kenneth said, "Good to see you once again." Okay. Izioma __ blog said, "Thank you, sir." Okay. Bright Jikunu said, "Nhyira, when is intervention lectures starting?" Bright, unfortunately, our executive revision masterclass is not open to the public. In other words, we don't do intervention. We've started with our executive revision masterclass, and that's what you are seeing now. So we'll have our Saturday, Sunday session where we are solving questions, and then we will have our executive revision masterclass proper, which is going to be 2 weeks to the exams for us. So we don't do intervention class, and our executive masterclass is not also open to the public. So Bright, it's not open to the public, so you cannot join. The only way you can join is if you're a student and you are part of the community already. Okay. Nanaya Owusu Kese said, Nhyira, please, when will you treat employee benefits? I cannot tell when we will treat employee benefits on YouTube, but it has been treated already in our main lectures. And so I don't know, but it is available in our paid program on our online portal that you can get access to on our portal. All right, Nanayao, I can't tell when we will cover it on YouTube, but it's available on our portal. Okay, let me bring back my screen. Let's go. So that is it about ratios. Does it mean now you are good? I don't know. Only God will tell. Because when I started reading the FR, the kind of ratio analysis that people wrote to me, hey, what trouble, bro? Well, I'm a miti cry me. Manya code. And now I'm a bro funti. FR4. Samuel said, having said the decision to sell the division should be investigated, will one not contradict himself for saying that it has helped it to pay dividend? No. The company didn't pay dividend because it wanted to pay. The question said that this transaction required shareholders' approval. And in order to secure this, the management of Yogi offered shareholders a dividend of this. So Samuel, it's not that the entity wanted to pay dividend. They paid the dividend to convince the shareholders to sell the business. So there is something fraudulent going on here. If care is not, the reason why we have to investigate this is that if care is not taken, they might have sold a profitable division to themselves, the management, so that they will leave the loss-making division to the shareholders. That is why they are using the shareholders' own money, giving it to them as dividends so that they will be happy, but they are sabotaging their own life. Are you getting the context, Samuel? That is why we have to investigate it. That's why we have to investigate it, because who does that? Who sell his profitable division? Nobody does that. Okay, that's fine. Okay, so let's get into some ethics here now. Now that we are okay with the ratios, let's go to some ethics here. Where's my ethics? Okay. What's the cursor on my screen? What's that? Where's that coming from? Please give me a moment. Let me bring back the love. We're opening an existing file. Okay. So we want to look at an ethics question. And this was a performance evaluation test done by the FR students. So for the CR students, I mean, it is something we are going to be solving. So FR students yesterday, right? Yesterday was Friday. Yesterday, you did the performance evaluation test. So we want to look at the question 2, which is ethics question, and then discuss it together to see exactly what we need to do. Remember, ethics is going to be in the exam hall for us. Minimum of 6 marks if the examiner is not happy with you. But if he falls in love with you, guess what? He's going to give you 10 marks. That means he's in love with you. 10 marks. And as I say always, 10 marks is cool. Okay, so we're going to discuss this together, all right? It's not me talking. We're going to discuss it together. Now, what was the guideline we said about answering questions relating to ethics? But let's get a context of the question, because it's very important to get a context of the question. It says, identify and explain the ethical issues arising in each of the above cases. Identify and explain the ethical issues. arising in each of the scenario. So as always, when it comes to ethical issues, we would have to identify, the threats. Then we can look at the fundamental code of ethics being breached, or we can take our answers from the fundamental code of ethics being breached, but you don't define it, but you contextualize it in the question. Sounds good? You contextualize it in the question. So stay with me, and then let's look at this together. Scenario number 1. Asamoah, this one is Asamoah Jan. Asamoah has been on a 2-year steady sabbatical in the USA. Please, like I say always, you read this with precision. It means you are attentive on what you're reading. 2 years steady sabbatical. Listen carefully. Now, 2 years steady sabbatical means this guy has not been working as an accountant. He's been studying in the USA. He's been studying in the USA. And this is his first job on returning to work. Oh, the guy has been out of work for 2 years. Now he got a job. Let's see. Asamoah qualified as an ICAG chartered accountant just before his sabbatical. All right. He's a chartered accountant. Then he went on sabbatical to study. He worked in a medium-sized practice with wide experience of clients in the mining, manufacturing, and agricultural sector. He worked. So what does that mean? This means before he became a chartered accountant. All right. So he's been working in the mining, and all that. Ashanti Assurance Limited. Ashanti Assurance Limited is a subsidiary of a listed group involved in financial services. So, okay, I don't want to give a lot of things out because I want you to talk. The financial controller of Ashanti Assurance Services has been on a long sick leave. Asamoah has been offered an opportunity as temporary financial controller 3 months before 31st December 20X9 year end. Asamoah will be responsible for preparing the financial statement for the year ended. Key areas of the financial statement include lessor accounting, financial instruments, and insurance contracts. During his interview for the post, the group director told Asamoah that the group is looking for a strong financial position and performance from the subsidiary, and that if Asamoah helps to deliver it, he is sure to obtain a permanent post in the group. He is sure to obtain a permanent post in the group. This is our scenario. And the examiner is asking us, what the heck is the ethical issue here? Any ideas? You raise your hand, we bring you up, or you put it in the chat. Now, give me specific answers. Don't come and tell me, advocacy threats. No. Give me specific answers. If you say something, explain concisely, not write essay. Concise, precise. I know by that definition, some people will not talk again. But I don't know why you won't talk, because in the exam, or what kind of English are you going to write? So what's the ethical issue here? I think that is all for the first scenario. What is the ethical issue here? What's happening here? Why was somebody coming up? What is happening here? Yes, James? Yes, James? Okay, Emmanuel.
I'm saying
Emmanuel, you can come.
Okay, sir. So with this, Asamoah is faced with the issue of self-interest in the sense that his permanent stay of the job depends on he presenting a strong financial statement. So with that being on the line, and he's somebody who is also back after a long study, so he needs to prepare a good financial statement so that he secures the job. So he's being faced with self-interest, which will impair his objectivity.
Anka last one, Anka mebo yem na wafi. So that is the idea there. That's the first thing. That is very true. So he's faced with a self-interest threat. And I like the way you put the explanation. And the last part was the most interesting aspect, because you don't just talk about the threat, but how does the threat affect the fundamental code of ethics? So the self-interest threat arising from the fact that he's been promised that, hey, you give us a strong financial statement, you got to keep a permanent job. So this guy is temporary, and you have come from the US and you have got some temporary work. Come on, man, you're going to do everything you got to do. So there's a self-interest threat, and that will affect his objectivity. I could take that a notch and say that it will affect his integrity as well in presenting the financial statement. Because remember, he's responsible to prepare financial statements. And if care is not taken, he will be presenting misleading financial statements as well. So his integrity and objectivity is going to be impacted or affected because of the self-interest threat. The offer that give us a strong financial statement and we're going to give you a permanent job. And this is the group CFO. And when the group CFO talks, I mean, it's final. Sorry, it's the group finance director. Charlie, is the final. Who doesn't want it? So that is the idea about that. So that is the first thing we can say from this question. Now, remember the way Emmanuel puts the answer. I'm not going to be writing any answer down. We are discussing it together. No. So don't come and ask me, Nhyira, how would you write the answer? We've written it already. We've said it. Listen and write your own notes. Samuel said his 2 years study outside might impair his professional due care, since he might not know the reviews on the IFRS and the fact that he is entering a new field. That is true. That is true. So his professional competence and due care, not that he's not competent, because the guy is a chartered accountant. So, he may be competent, but then due care, could be a problem here in that regard. Okay, so he's been out of study, sabbatical. I mean, gosh, spelling, no. Sabba, double B. Okay, sabbatical study leave for 2 years. Plus, he's been working in what? Mining, manufacturing, agriculture. This is an assurance company. And an assurance company, they are dealing with lessor accounting, they are dealing with financial instrument, they are dealing with insurance contract. This guy may not be cut out for this. This guy may not be cut out for this. So that is a good thing there. The professional due care on the preparation of the financial statement may not be in line with the requirements of the standard, because this guy has been out of work for 2 years, and also he has experience in different industry. Experience is outside the industry, sector or industry of the entity. So yes, that is another thing that we can say, Samuel, that is correct there. Then Vivian is saying that Asamoah does not have the experience on the job, thus may not have the professional competence. Okay. It's a little light and low in that particular case. He's a chartered accountant, so he has some level of competence. It's not easy. Chartered accountant is chartered accountant. But the due care part is where, you know, that fundamental code is professional competence and due care, right? So competent-wise, he's a chartered accountant. So this means that he has achieved a high level of competence. But the mere fact that he has been out of the profession for 2 years and he has experience in industries that are outside the current jobs industry, his professional due care will be on the line. His professional due care will be on the line in that case. So yes, competent-wise, he may not have enough, but then due care also is another thing that we can say there. Any other issue? Give me a moment, let me pick. Let's see. Asa. Hey, FR4, is that what you wrote in your FR test? I've not finished marking your script. But for Bonnie, I'm a church and I'm code into Mijaya. Kofiga said he faces integrity threats since he is new. So I don't know better than Kofi. How does the integrity, did I say integrity? Intimidation threat, how does that come in? Okay, you are saying since he is new. Okay. But dig it a little bit deeper. Maybe dig it a little bit deeper. Work it a little bit deeper for me in that particular case. Intimidation threat. How is that coming in? He is new, yes, but that is not enough. If you are new, are you intimidated? He's new on the job. He's been promised, right? In the question, we are told that the finance director said, hey, listen, you do a good job, you get your job, man, nigga. It's as simple as that. Give us a strong financial statement, you have a job, and you can take care of your wife, take care of your children, and we will love you forever and ever. Amen. So the intimidation is coming in here, yes, for the fact that he's new and he's a temporary staff, but then also because of the promise of the finance director, the group finance director. And this intimidation threat will then impair his integrity. He may prepare misleading financial statements and will affect his professional judgment, his objectivity. Does that make sense? So that is the issue about that. Jennifer said, Asamoah is faced with undue pressure to please the finance director. Also, he is challenged with self-interest issue arising from getting a permanent job, which might distort his objectivity and professional behavior. Hey, Charlie, distort his Aboa. Jennifer is, splendidly, trying to be meticulous and circumspect in her choice of words. Yeah, but that is true. That's a good point there, Jennifer. So yes, Asamoah is faced with undue pressure to please the finance director because he's new on the job. That's very true. And there's a self-interest rate. I like the way you put your point also, because there is some issue about professional behavior here as well. All the threats that this guy is exposed to could cause him to not act in line with the ethical codes. Okay, so yes, it would affect his professional behavior. So that is very true, Jennifer, on that. I'm seeing some chats coming in on YouTube. Timothy said, self-interest rate, that's permanent job, which will affect his integrity. Okay, that's true. Daniel Kofi Latevi said, Nhyira, you are really doing a good job. Please, I would like to know when you do the live session so I can join. Subscribe and stay connected, or follow us on Instagram. It'll be posted there. So I think that is all about the first case. Am I supposed to write any answers down, or everybody is good? So be here. Everybody understands, right? Everybody understands what you have said. I'm not supposed to write anything down for you, right? Right? Oh, not thanks be to God. I have good students who understand things like that, and they make my work so lavishy and interesting for me. Let's go to the second scenario there. So remember, like I said, the structure of the answer is very important. Okay. So if you are looking at it from it, you are looking at it from the threats the person is exposed to. Tell us how the threats came by, and then tell us the fundamental code that is being breached. If you are going to come from the professional code of ethics, don't define the code of ethics, contextualize it. Then you tell us how it will affect the person generally in that particular case. Okay, that is the idea. So the structure of the write-up is very important. It's very important. Let's look at the second case. Case number 2. Boydi, Akwawe Pade Wabon. I said Boydi. What kind of thing is that? Shradie, oh, Davi. Bema Beni. Boydi, you see Boydi. Boydi is an ICAG chartered accountant and works as a financial accountant working for Brekum Builders PLC. This is PLC. So he's a chartered accountant, work as a financial accountant for the company. Let's go. Brekum Builders PLC is about to finalize its financial statement for the year ended 31st December 20X9 and will release its results in 2 days' time. Wow. They're about to finalize and they will release the results in 2 days' time. That's some serious things. Let's go. One of Boydi's tasks during the frantic year-end work was to perform an impairment review on certain assets owned by the company. There were indications of impairment by Boydi's calculation of recoverable amount showed that, there were indications of impairment by Boydi's calculation of recoverable amount showed that no assets were impaired. Boydi has just read an article on spreadsheet error. This led him to review the spreadsheet that he built to perform the recoverable amount calculation, and he has found an error in the logic. This error, if corrected, would have led to the company recognizing a material impairment loss. The loss, if recognized, will lead to the profit figure falling below the level at which Boydi's bonus is triggered. Whoa. He is also concerned that his mistake will compromise his future promotion prospects. What do you think? This guy here is preparing the financial statement. He's the boss. And in 2 days, the financial statement has to be released. He has done an impairment review, identified that there is an error. The error is material, but if he corrects the error, the profit of the company will fall beyond a certain level and the bonus will not come. But not only that, his own future prospect is also on the line. So he is concerned that his mistake will compromise his future promotion prospects. So what can we say here in the context of this question? Yes, James?
Mr. Boydi is faced with self-interest threats, and in the form of his willingness for the promotion and his annual bonus. And this have the ability to affect his objectivity and integrity.
Okay. Yeah, that is very true there. That is very true. So Boydi is faced with, so case number 2, Boydi is faced with self-interest threat. That might compromise his professional integrity and objectivity. Remember, I told you something. I didn't mention this in the first case. You see, in the context of this question, the examiner just said the ethical issues. But when you are answering, it is prudent for you to tell us what the person should do instead to mitigate the risk. Always it is advisable. So I didn't do that in the first scenario. I'm going to try to do that here for us. So we won't just write what the guy is facing, but we will write what the solution has to be. So what should be the solution in the context of this question? We've stated that the personal interest of somebody must not be what? Placed above the professional presentation of the financial statement. So the requirement here is that Boydi must, set aside his personal interest and correct the error. Correct the error to represent that will make the financial statement represent the true and fair view. Sorry, that will make the financial statement be represented faithfully. I want to use that word. True and fair view is an audit term, but I want to use the financial accounting term. That will make the financial statement be faithfully represented. This is more of financial accounting. True and fair view is more audit term. Are you getting it? Even though I could say that, I would rather put it that way. So Boydi is faced with self-interest threats that might compromise his professional integrity and objectivity. What is the way forward? He must set aside his personal interest and correct the error that will make the financial statement be faithfully represented. Are you getting the idea? So I didn't say that in the case one, but it's something you have to pay attention to always. If the question just says, what is the ethical issue? It will be right for you to write the ethical issues and also state the course of action, just one course of action that the person must take. Even though you are not asked, it is part of professional presentation that you make some recommendation on that. Are you getting it? So please pay attention to that. I didn't do that in the first one. That was a mistake, but you have to pay attention to that because the context of the question determines the way you answer it. So even though you are not told the courses of action, it is important that anytime you raise the ethical issue, you have to write out the course of action. So yes, he's faced with that self-interest threat. What else can we talk about here? What else do we have? Let's see. I'm seeing some charts coming in on YouTube. Let's see, since we are with them. Self-interest threat, that is bonus and future promotion. This will affect his integrity, objectivity, and professional behavior too, is in the mud. He should go ahead and correct the error. Since his integrity is more important than the bonuses and future promotions, and he is expected to act in the professional manner. Okay, so Timothy is also bringing up one other thing that we need to talk about, and that is professional behavior. Okay, professional behavior. We got to talk about that. Professional behavior. So the way Timothy put the point up is that professional behavior too is in the mat. And he is talking about professional behavior arising from the fact that the guy's bonus and future promotion is on the line. Okay. And so the point we explain above there can affect his what? Professional behavior in the context of this particular question. So what we can say here is that he has made an error which must be corrected. As such, Boydi must not allow the promotion and possible bonus to make him act unethically, which may bring disrepute to the profession. So again, you see that I didn't define professional behavior, but in my explanation, professional behavior definition is coming in naturally. Okay, it's coming in naturally. Samuel said he shouldn't put the name of the profession into disrepute, okay, by condoning over a perceived error because of his interest. That's right, okay? So Samuel, that same thing is what we have put here. And I like the way your statement is also put, that he shouldn't put the name of the profession into disrepute by condoning over a perceived error because of his interest. So that would describe professional behavior. Frank said, if this question had been asked in audit, would the structure of the tone of the answer be different? I don't get the context, because in audit, we are not going to prepare financial statements. We are going to examine financial statements. So we won't have this tone of question in audit. Does that make sense? Because here we are preparing financial statements. In auditing, we will be reviewing the financial statement. We'll be examining the financial statement. So the structure of the question will be different. The tonation of the question will be different. Does that make sense? So we cannot contextualize it for audit. It's not possible. It's not possible. Yes, James, your hand is up.
Hello, sir. My issue is for the first case. You realize that the first case was a general issue where they say we should identify the issue arising. And I want to say that the group's financial director wanting the financial statement to be prepared in accordance to his desire and way, can't we say that it's a sign of poor corporate governance and internal weakness, internal control?
We were not told that he wants any financial statement to prepare. He just said the group is looking for a strong financial position and performance. There is nothing about governance there. It's normal for every finance director to have a strong financial position. So there is no much information available to talk about governance. It does not, a group finance director's role is to prepare financial statements and make various financial decisions. So certainly it is his job he is doing. So not that he's dominating. If it was that the CEO, he's doing this, he's doing that, then we can talk about governance. But in the context of this question, the person talking is the one responsible for the role. So he's not exerting any undue or authority over his boundary. So we cannot talk about governance here. We cannot talk about governance because of the context of the way it is put. So we can't talk about governance.
Thank you.
All right. Abdullah Mazouk said, professional competence and due care. This requires Boydi to apply his skills with due diligence. And since he's already a chartered accountant, he is required to apply his skills very well. Oh, why would you talk about professional competence and due care here? Is the guy being incompetent, like Adodi and the finance minister? He's not incompetent here, right? He has seen his error. His issue here is, should I correct the error so that we don't get the bonus, and I will not please the group finance director, and I will not get my promotion, or I should stand my grounds and do the right thing? I hope you are getting the idea here. So there is no issue about competence here. He read an article and he has seen his error. So he knows the right thing. He knows the right thing. It is the spreadsheet that he used that made him to get the error. So it's not an issue about he doesn't know about impairment, but probably the formula of the spreadsheet, he didn't put it across well. So it ended up giving him an error in the figure that he's arrived at. So after reading and taking a chance to read the spreadsheet article tells you that this guy is a continuous learner. So competence, no, Abdullah, we cannot talk about competence here because the guy is skillful. He's just bothered on whether he should do the right thing or not to do the right thing. That's his concern. Does that make sense, Mazouk? That's his concern here generally. That's his concern here. So what do we have? We've spoken about the fact that his self-interest rate is on the line. And then we've spoken about professional behavior as well in that particular case for us to talk about that in that regard. And we've mentioned that the self-interest rate will affect his integrity and his objectivity. Any other ideas? No. You can't talk about due care here again because the guy is not having a problem. His problem really is about not preparing, not being honest, integrity, which we've spoken about already, his objectivity being affected because of his bonus, and then also the fact that he may bring shame or disgrace to the profession. Sounds good? So this is the answer that we can provide for this question. And that's ethics. Again, trying to revisit ethics. We did this in week 2 or so, and week 2 or week 3. And we are just trying to revisit it. My key thing here is the context of the question and the way you write the answers. Like I said, this question just said, explain the ethical issues arising in each of the above cases. So even though the question said, oh, explain the ethical issues, like I mentioned, you will be better off to state the causes of action as well. Maybe just one cause of action, what the person must do to mitigate the threat. Even though they didn't say that, you have to write it out because that will make your answer more acceptable and well presented. Yes, Koima.
Okay, so with this one, when are you going to take all the ethical issues, then you talk about it? How the question be put? If you can,
this particular question, you could go in any routes because you realize that we're doing a mixture. In the first scenario, we're doing a mixture. We took the threats and then we blended up with a code. And then the next one, we took the code itself and then we blended up with a threat. So in the context of the question, you can choose any route, but you must know how to go about it. Like the second scenario, I could talk about integrity because there is integrity here. So I could talk about integrity. How will I talk about that? I will say that the promotion of Boydi and his probably bonus, it's likely to cause him to present a misleading financial statement for the year ended under review, breaching the code of integrity. Then I will come to the second point, objectivity. The threat of the self-interest threat faced with Boydi and the statement of the group finance director to have a strong financial statement puts undue pressure on Boydi. This means that the professional judgment of Boydi may be impaired. Objectivity. Objectivity. Then professional, no, we didn't talk about professional competence because the guy is not competent here. He's not also do you care, but professional behavior. Boydi as a chartered accountant is required to ensure that where there is a conflict between personal interest and the fundamental code of ethics, the fundamental code of ethics play or is, what's the word? The fundamental code of ethics is the best alternative in those scenarios. As such, Boydi must act in a manner not to bring shame or disrepute to the profession. Are you getting the concept, Emmanuel? So you realize that I'm answering the same question, but from the perspective of the ethical codes. But in my explanation of the ethical codes, I'm talking about the threats and what the person must do.
Okay. Okay. Thank you very
Sounds
much.
good?
Yes, very well.
Okay. Okay. Any other questions? Everybody good on that?
Yeah.
Winnie? Yes. Salifu?
I'm okay.
Oh, okay. So that is the context of the issue there. So you could take the ethical codes, but don't define the ethical codes. Contextualize your answer. Then you could also start with the threats, then you blend it up with the ethical codes. It's just alternative. You have to identify where is my sweet spot and where am I, really good at generally in that particular case. And so that is also about ethical issues that we want to, review with you. The next time we're going to look at ethical issues, maybe that will be during our revision masterclass. So we will solve some other questions as well. But like I tell you always, make sure you expose yourself to a number of questions, because the more questions you expose yourself to, the more you'll be able to understand the various aspects of the code of ethics, so that you can really do well in that case. And if you look at your question kit, we have a number of questions available in the question kit. You can try your hands on some of them, send it over. I will mark it for you, because like I said, this is minimum of 6 marks, maximum of 10 marks, financial reporting, corporate reporting, waiting for us in the exam hall. So you have to know it. You have to know it. All right. So I'm going to wrap up today here. And I don't know, I think our next meeting would it be next 3 weeks? Did I say next 3 weeks? That's too harsh now. Let me see. When is our next CR or FR? Masterclass? Yeah, week 3. That'll be 5th of November. And that'll be IFRSs. Okay, so we'll be looking at IFRSs next 3 weeks. Then next 4 weeks, we'll have another one. Then week 5, another one. Then week 6, that one we are preparing to go and write the exam. So question and answers. So that's it about that. And that's the purpose of this class, to walk you through ratios again, giving you the guidelines on how to do the calculation, but most importantly, how to interpret it. Then number 2, talking about ethics, how to write out your answers and how to identify exactly what is going on in the question. Remember, ratio is 20 marks, minimum of 15 marks in the exam hall. But there are other aspects of ratios as well. We're going to be solving some other aspects of ratios later on during our revision session in the respective classes. And you're going to see that as well as we go. The main thing is expose yourself to questions. That's the only thing I can say. If you expose yourself to different kind of questions, you will be good. So especially for those of you who have a book available on the corporate reporting, financial reporting, we have a lot of questions in these books that will help you to know how to write out your answers and the various aspects of the question. So just expose yourself to questions and you should be good. So that's it about that. We end here today, and we shall meet next week in the course of the week. MA people, you know, tomorrow we'll be meeting for short-term decisions. So that's it. Goodbye, and make sure you go to church tomorrow. All right, don't sleep.
Man, I'm resting.
Hello, Ishra.
Yes.
Ishra,
I'm resting.
please, will you post this thing on our page? The recording.
Video, yes, it will be available.
Yes, because my network was just messing up, so the thing, unless I watch it again.
All right, so it will be available on the portal in maybe like 25 or 30 minutes.
Okay, sure. Thank you.
All right. Okay.